right, everyone, this is Vishal from Equity Guru, and today I got to talk about the debt markets. Specifically, we're going to be talking about what's going on in Japan and the Bank of Japan. As you can see from this article, which came out earlier this week, I did talk about, yes, stock markets are scary, but this market is truly frightening. And I've been talking about the debt markets. If you followed my work earlier on this year, April, and also, well, yeah, both articles came out in April, mid-April there. I talked about why the Bank of Japan is the most important central bank in the world to be watching. Some of you guys might be following currency pairs, and the yen is, just getting hit. It hit lows that it hasn't seen since 1998 compared to the US dollar. And I'll show you that chart because some of you guys might not believe me, but that's the price action that we are seeing. The yen is gaining some strength right now, but if I go out to a large monthly chart, you can see we've had this epic rise in the yen in the decline in the yen, sorry, in the past like 4 months. And it's to do with the fact that while all these other central banks are raising interest rates, the Japanese are keeping rates low, right? They're still in negative, and we'll talk about big moves in that 10-year yield. But I think I should just mention Weston Nakamura out in Real Vision. He's been talking about this. So if you're watching Weston, good work, man. Great stuff there. But he's been warning people about what's going on in the Bank of Japan and why you should be watching it, because I think a lot of us are, we don't pay too much attention to the Bank of Japan because they haven't really changed their monetary policy since like 2016, right? It's always been the same press release. Nothing changes, and we all say, okay, yeah, why do we even have to pay attention to the Bank of Japan? They're not going to do anything. They're going to continue to keep rates low and also buy government bonds. So you can see here, I wrote this article near the end of April where the Bank of Japan is doubling down on dovish monetary policy while the rest of the world, well, most of the world was raising rates. I say, most of the world because, of course, the People's Bank of China is also quite dovish as well. But in this article, I talked about how the Bank of Japan, they were dealing with this 10-year Japanese government bonds, and I'm going to call them JGBs. They wanted to keep these rates below 0.25 on the JGB, and we saw this epic rise in the 10-year yield on JGBs, and we were getting very close to that 0.25 threshold, even breaking above it a few times. And essentially, the Bank of Japan had to act, and they said, hey, look, we're going to offer to purchase 10-year JGBs at 0.25% every business day through fixed rate purchase operations. Essentially, print more yen, buy bonds, keep the rates low, because as you guys know, or maybe you might not know, there's this inverse correlation between the price of a bond and what it yields. So if you buy a bond, the yields tend to go down. You sell off those bonds, the yields sort of rise. So that might help you understand, when a central bank is doing quantitative tightening, when they're selling off these bonds on their balance sheets, what that does to the yield. So that's what the Japanese wanted to do, right? They wanted to buy these bonds because they want to make sure these rates do not spike. So this is again in April, and just recently I wrote this article at the beginning of this week warning people that there's things happening in the debt markets, right? We're seeing, yes, the US 10-year yield rise, but there's things going on in Europe and things going on in Japan. So I'm not sure if you can see this chart clearly, but let me open this because I really want to show you what happened in recent days where we saw an epic spike above 0.25, hitting 0.34, hitting 0.30, and obviously the Bank of Japan had to jump in, whatever they had to do, print their money, buy those JGBs to keep the yield below 0.25 there. So this is from earlier this week. Take a look at the chart of the JGB on the day of I'm recording, and it's pretty scary stuff, folks. We have about a 79% pop here, according to my TradingView ticker here, and we've taken out all those levels that we saw, or what I just showed you earlier this week. We're at 0.45 Obviously, the Bank of Japan should be stepping in near the end of the day here, buy up all like amounts, tons of JGBs, unlimited amounts of JGB, whatever they have to do to ensure that this candle sees a large wick like this and we close, back below 0.25, right? So that's what we should expect to happen because the Bank of Japan is remaining dovish. However, things have developed interestingly in the past few days here. Earlier on, or in yesterday's video, I talked about the ECB, right? The European Central Bank. Rates in Europe or in certain countries in Europe are also rising. There's this epic rise in Italian 10-year government bonds going above 4%. And as you can see, the ECB said, hey, we're going to explore some tools to perhaps control these rates, which to most of us, it's okay, have the ECB now pivoted, right? They said that they're going to start raising interest rates come July, but are they now going to have to buy bonds, do some more easy monetary policy to try to keep interest rates or borrowing costs in other parts of the in other countries in Europe from rising, right? So now it's saying here that investors are becoming unconvinced that the ECB can actually raise borrowing costs because we're seeing an epic rise in that 10-year yield in Italy, also in Greece and a few other countries. So what's this tool going to be, right? How can they manage to keep rates low and also raise, their overnight rate there? So a lot of people are saying the only tool they really have is what they've been doing, essentially since 2014, I guess, and that is just buying bonds, right? So going back to that easy monetary policy. And there's some people saying that because of this whole debt market issue now, other central banks around the world might have to reverse policy down the road because they're saying, rates are going up way too high and they're spiking up way too fast. The Europeans are back to, easy monetary policy. The Bank of Japan is still there as well. Maybe the Fed joins in, right? That's what some people are saying. So keep an eye out on the 10-year yield on the US side of things. And it might get worse here with what's going to happen here with Japan. But before we talk about that, again, understand the ECB is very open to stepping in, which is now leading people to say that, okay, they might not start hiking rates come July. This happened today. Swiss Central Bank, or the Swiss National Bank, that's what their central bank is called, the SNB, has surprised markets with their first rate hikes since 2007. And they have taken rates now from negative 0.75 to negative 0.25. Even though the franc has been quite strong, obviously they're now trying to deal with inflation. And this is sort of surprising, folks, because the Swiss Central Bank is up there, I would say, with the Bank of Japan as these banks that no one really pays attention to, right? No one really thinks these guys are going to do anything because rates have been negative. I mean, I guess you can include the European Central Bank there as well, but it's usually the Swiss National Bank and the Bank of Japan. But now you see that the Swiss have surprised markets and have begun to raise interest rates. And just to show you what happens when markets are not pricing things like this in, we have an almost 3% increase in the Swiss franc against the US dollar. Again, when this chart is moving down, when you have a big red candle, it means the Swiss franc is strengthening. And you see that with a lot of the franc pairs, right? So if I take a look at Euro Swiss franc, which I say is quite the important one because Europe is the largest trading partner, that's also declining. You can take a look at the other moves in the Swiss franc against the pound. You can see it's losing its steam now, but pretty big move on the Swiss franc, especially there against that US dollar. So very surprising. No one was expecting that. I only say this because Japan is coming up next. We're going to hear from the Bank of Japan. It's either tonight, Pacific Standard Time tonight, or tomorrow morning. They don't really give us a time, and maybe that's on purpose right now. I don't know. But we're going to hear from the Bank of Japan, and it gets things a bit more interesting now because, the Swiss are doing their things, and a lot of people are saying, will the Bank of Japan capitulate, right? Will they start having to raise interest rates because these yields are spiking. A lot of traders are saying this is sort of breaking the Bank of Japan trade because with the yen weakening so much, a lot of people are expecting that the Bank of Japan may need to step in because how much weaker will they allow the yen to become, right? You got to factor in the fact that Japan imports a lot of oil and imports a lot of energy because obviously Japan doesn't have much natural resources there. And to do so, they have to do it by buying US dollars, which is now a bit more expensive to the Japanese there. So a lot of people are saying that Japanese or the Bank of Japan might capitulate because they need to strengthen the yen because it's gotten so weak that it's getting much more expensive to import a lot of these things. Great for exports, right? Obviously great for exports because now it's cheaper to buy Japanese goods because the yen is so weak. But the big issue here, folks, is you have to realize the Bank of Japan and the Japanese investor, right, per se, has been very important to world markets for the past, decades, right? Because interest rates were so low in Japan, what did that Japanese investor do, right? Where did you've heard about the boomers in Japan, right? A lot of these people with money, they survived that Keizai or that boom economy in Japan. What have they done with their money, right? A lot of people are saying they're looking for yield. Where did that money go? And most of us know it, but it did go into buying bonds, right? Foreign bonds, right? Safe investments, and the U.S. treasuries were the safest, and this is why Japan is the largest foreign holder of U.S. Treasury securities, right? They hold the most bonds, hold the most foreign debt, right? So what this means is, and again, the guys at Real Vision, Weston Nakamura, explained this really well. What this means is it's been the Japanese investor who's been keeping rates in America low for many years because, again, remember, when you buy bonds, the yields drop, right? So in a way, even though the Japanese are they're doing something called yield curve control, right? Trying to keep interest rates below 0.25 in Japan, or the 10-year JGB below 0.25 in Japan, in this inadvertent way, because the Japanese investors buying a lot of foreign treasuries, they're also doing yield curve control in a way for the Americans. And because of that, because of the fact that it's the Japanese who are buying, we'll get to that chart in just a second, but just because the Japanese are buying so much treasuries, that's what's allowed the American government to, have these large deficits and spend on all these crazy programs, and rates are low, right? But the issue is, folks, if the Bank of Japan starts to raise interest rates, right? If people break the Bank of Japan here, if they don't hold this 0.25 on their 10-year JGB and they allow rates to normalize, some of this money in Japan might say, hey, why should we go overseas now? Why don't we buy things domestically? And of course, some of you guys might think that's a bit crazy, but you got to realize in Japan, the inflation rate is still low. A lot of these producers have actually eaten the cost, right? So yes, the PPI is like 9% or 8%, I believe, in Japan, but the prices aren't really changing because the producers there are basically eating the costs. And Weston Nakamura talks about this, that a lot of the businesses in Japan, they're very price sensitive. Like even if you change something by like 10 yen, consumers get very angry and might shift to something else, right? So you've all heard about prices in Japan and how they've been sort of flat, and it has to do sort of with that consumer economy there. And also the fact that, the Bank of Japan owns a lot of these companies itself, so they can easily give these guys money if they need to, right? And we know the Bank of Japan is buying stocks and also investing in ETFs and, well, companies as well, right? There's this talk of like how there's like a Bank of Japan member on like the corporate boards now because they've invested so much in these companies. So, if inflation is low in Japan, maybe something yielding close to 1% or 0.45% on the JGB might be attractive, right? That's all I'm saying. Yes, U.S. yields are much, much higher, but maybe it's safer, buying something domestic than foreign. So Nakamura has been explaining about this. If Japanese government bonds begin to normalize, Some of these guys here might be saying, hey, you know, why buy US foreign treasuries when you can maybe buy things domestically? So it's going to be a pretty big move, and that means someone has to sort of step in to buy that excess, the demand that Japan had. Someone will have to step in. Will it be the Chinese, who are number two? You can see here. Maybe, maybe not. I mean, there's some talk that they might even dump some of their reserves because they've seen what happened, with Russia, right? Russia's 300 billion reserves or foreign reserves just got basically frozen. And if the Chinese do have plans to do something to Taiwan, maybe they take steps to sort of lessen that dollar demand and not increase their dollar demand. So that's something that people are talking about. Will it be domestic funds, right? Will hedge funds say, hey, maybe it's safe now to buy US dollars or treasuries rather than stocks right now? And some even say, folks, that maybe the Fed does what the European Central Bank might have to do. Maybe the Fed has to step in and buy bonds again, pause hiking interest rates or stop hiking interest rates, and sort of go back to easy monetary policy. The one, I guess you could say, hopeful thing, but I don't really want to say hopeful because if there's some Japanese viewers here, they might say this sort of sucks. But look at how large Japan is in terms of debt to GDP. This is a government debt by country, debt to GDP ratio. Japan is the most indebted country there at 256.9%. You can see, Italy we talked about earlier, they're at 154.8, so they're just in the outer circle there. Greece is there as well. And then you have, Canada and the US, Portugal, Spain, France, Belgium on that third outer ring. But this is the issue, right? Like Japan has so much debt that perhaps even a small increment rise in interest rates in Japan might be pretty bad, right? It might not be like government and other institutions won't have enough to service the debt, right? Won't have enough money to service the debt because it gets so expensive because Japan has the most debt there, and they sort of are stuck with negative to low interest rates. But watch this 10-year JGB because now the Swiss National Bank are acting, and Japan sort of becomes that one major Western central bank that is not raising interest rates. And in a way, I've talked about that in my article this week. Mr. Kuroda, Haruhiko Kuroda, who's actually, I think he's almost about to step down. So probably not going to be any changes, right? But with what's going on in the world, maybe the Bank of Japan does not want to be left behind. But this man is essentially holding up the entire financial system with keeping rates low. And if this man ever falters in a press conference or, even like farts or something, I don't know, right? But if he even like gives any sort of sign that the Bank of Japan might begin to allow rates to normalize, I think you're going to see a large spike of yields in the US, likely a big drop in the stock markets as well. So keep an eye out on what's going on in the largest market in the world, that is the debt market, and keep an eye on this 10-year JGB, and I think even that Italian rate. So a lot of eyes I know are focused on the stock markets, but we are seeing some major action in the credit or the debt markets, bond markets, whatever you want to call them. And in a way, the stock markets are technically a derivative of the debt markets. Like everything moves in the debt market, and that affects the price of everything else. And central banks, kept interest rates artificially low. The US or the Fed, they did what's called Operation Twist, where they were buying, the long end of the bond or the yield curve to keep rates low for the long end, to sort of force money to run into stocks and real estate, and I guess some might even say crypto as well, right? Because they created this environment where money had to go and chase yield, and that might be ending now because if interest rates start spiking up, a lot of that money might get out of stocks and other things that it was sort of forced to get in and run into the safety of debt. But that's a topic for another video, because then we're talking about, okay, is this debt even safe? And obviously, if you're someone that invests in gold and silver, even Mr. Ray Dalio himself, right? you might not say that debt is safe, and you might want to be in assets that are not fiat related or central bank related. And as I said, gold and silver. Well, you can sort of see that. Well, you can't see it now because on my other videos I have a nice gold bullion vault behind me. But I'm a bull on gold and silver. And I think with all this action that we're seeing in the debt markets right now, I'm not doom and gloom, right? I'm not trying to be doom and gloom, but I do think that this is things that you have to watch, especially what's going on in Japan, because not very many people were expecting a candle like this. I was even surprised when I saw candles like this just a couple of days ago. And when I saw this, I was like, oh boy, there's something going on there. So who's going to capitulate, right? Is the Bank of Japan going to capitulate, or are they going to continue to print yen, weaken the yen, and force rates to stay below 0.25 on that 10-year JGB? And our traders going to allow that to happen because there is this breaking the Bank of England, but now breaking the Bank of Japan trade going on, especially if that yen continues to weaken. I know this has been a long video, a lot of things that we've talked about, but I think it's very, very important. Again, I do recommend that you read my articles on the Bank of Japan, which I wrote in April. I will post these at the bottom of this video in the description box, so you can go and read this stuff. And also the fact that we had recall, I guess you can say, what's going on with the debt markets earlier this week, and then the day after, boom, the European Central Bank basically began to pivot. So I'll have all three of these articles at the bottom of this video at the description box below. Definitely do read it and reach out to me. Let me know what you guys think, because I think this is some crazy stuff going on in the debt markets, and I want to know what you guys think. If this is the big one, if the debt bubble is going to collapse, or do you think central banks are going to now reverse and jump back in to buy bonds, bringing rates low, but then in a way not raising rates, so allowing inflation to run away and possibly even hyperinflate down the road? Who knows? Let me know in the comments below. I really want to hear what you guys have to say, and I'll catch you guys all in the next video.